The best is at a level 3. I know we're going to reject, but after the current move to the upside, once we get to that level and fall back, we can have a buy stop at $75. It's a level 3. It's right where you expect the market to reject. But again, the implementation is important, is key, and the implementation of a buy stop is only after the market has tested and failed the 200-point moving average. After it fails the 100-point moving average, moves back to $73, have the buy stop in. If we attack the 200-point moving average again, then probably the market is going to reverse. If not, market goes down to $68 and $64. Almost logic entry. I don't think we're going to see $64, but I think we are going to see $68. Seriously, I think we're going to see $67.76, $68. I believe this is going to be support 2 next week, not this week, or on this 30-minute chart. This is going to be between support 2 and support 3, or probably between support 2 and support 1. Very likely entry, very good entry if we get to see it. So we stand down until 68. And anyway, even if the market goes lower and we do an entry at 68, we can protect it all the way down to 64. By doing hedges, we can protect it by taking a small loss, for instance, and adding at lower levels. So we can protect it because the entry at 68 is very viable. It takes you at least immediately to 74 and 75 and 73. And on escalations or on better economic performance takes you to 78. And of course, on escalations take you much higher. Would be probably the secular bottom. Right, let's look at the momentum pictures. I'm looking at the 30 minutes. If you see any positive momentum on the 30 minutes, on the 15 minutes, on the 5 minutes, I believe these are all sell triggers. So let's take a look at this to understand how to use them. But we would not use them trading oil again. It's better to use them trading currencies. So of course we know that we're doing a wave 4. We think anyway that we're doing a wave 4, and that 4 is really an A where you have that very small momentum picture or very small momentum spike, a B at this point. And then a C, and C has done a 1 and a 2, is doing a 3, and 3 is an internal 1 and a 2 at that point, and a 3. So everything becomes easy to project in a way. I can actually project from you need to wait a bit. We have a trigger 2 here, and it is a correct trigger 2. It will work. After a while, I can measure leg 3 to leg 5. So leg 3 is now in progress, and we can actually do a long at this point if you wish to long. It's actually an opportunity, but the fundamentals are not really correct, but nevertheless, it's an opportunity. Right, so I know I have an A, I have a B, I have a 1 and a 2 at this point, a 1 and a 2 and a 3. Let's just indent the 1 and 2 and the 3s. I just buy market. I buy market and go to the neckline, of course, and that is all. Neckline is the level 3. All right, that's what we're seeing. Usually we don't do this except in a trending market. If we don't rely on such as an advancing segregation or a bounce, except in a trending market. This is not, of course, a trending market, so 4C does not have to be higher than 4E. 4C can be lower than 4E, and the position can backfire on us and we can be in a loss. That's why we are not promoting longs in oil at this point. But typically, this is, if you have to do a long in oil, this is where you start, where you do. We buy market at that point on retraction right now, 73.64. If the market falls below level 1, you close out immediately. This level 1. If you fall below this level 1, wait for a bounce and close out. If the market doesn't fall, hits level 1 and bounces higher, perfectly all right. You can get, this is an ending diagonal, hit level 1, but you cannot fall to the lower boundary of the ending diagonal. You just buy level 1. And we take profit below level 3. This is a level 3. We take profit $74.50. So the entry is probably $73.50 or $73.60. Now it's $73.70. The profit is $74.50. It's 80 points, 80 cents. And that is it. And really, that is it. Very small target, but this is what we can get. There's going to be a retraction and then another test. You can see here 3 in yellow and a 5 in yellow. There's going to be a retraction, another test. Maybe we get 74.80 again, maybe 75 at the most, becomes a sell, and you are back into a 5. Right, so if that is the long that can be done today, I cannot do this long and hold it to $78. I cannot do this long and hold it to, unless there is a sudden geopolitical impact, I cannot hold it to $80 and $84. I cannot also, let's say, press my luck, just buy the long and hope that something goes wrong geopolitically and the market moves higher. Let's take a look at the higher momentum picture. Start with the 4 hours, just allow the market to charts to load. So you see degree 3 negative momentum. Yes, it's attempting to be contained, but it can also do a prolongation like the one showing here. So, and we are well immersed below level 3. Take it to the day. We have an indentation 4, so this is very interesting. It shows that you still get another run to the downside. You sign, this is a higher indentation and momentum than this one. And typically, of course, the one here is a 2, all right, and the next one is a 4. But here you have both at the 200-point moving average. And so it would look like that we're getting a divergence of sorts. So it looks like we have a 1 and a 2, probably a 3. At this point, a 4 and a 5. Maybe if we break the 200-point moving average, then we have reversal into 1 and a 2, and we're moving higher. If you don't, this is an indentation 4. It's higher than an indentation 2. All right, but it is showing same price level, which means a higher degree correction. A higher degree correction could still resolve to the downside. If we add all this into a 3, we have an A, B, and a C, and we still resolve to the downside. And therefore, there's continuation. This trigger is for continuation. The longer term daily chart, also, we've always been considering, we see this daily chart on our own analysis. And visually speaking, we believe we are attacking the upper boundary of a leading diagonal. We remember this chart now. And we're expecting breakout higher to attack the neckline, but the fundamentals are not there for higher prices because there's no demand. All right. And if we have attacked the upper boundary of this leading diagonal and failed, we have a very strong momentum failure. The logic is, of course, we fall back to the lower boundary of that leading diagonal. And this is 64. Yes, it's 64. And so we still get a wave 5, sorry, to the downside. Of the internal segregation on the minutes that we've just been doing, of the 30 minutes, we get this. We go all the way to 64. All right. And in order to make sure that we understand this, you want to confirm it using a projection on the daily. It's probably the price action we're going to be seeing. So we're doing a bit of a deeper head inside of this leading diagonal. Right, we're expecting a double inverted head and shoulders, breakout higher to attack the neckline. This failed. Right, so what do we get is actually this. Heads, shoulders, I can just invert the pattern because this is a cycle. Either we're attacking the upper boundary of the cycle or attacking the lower boundary of the cycle. So just a matter of rearranging the necklines. Right, so we can see double, of course, heads and shoulders. Are we going to break the neckline? Of course, suppliers will not permit this, but we are going to attack the neckline. 69 definitely. We're going to fall below because most likely we're going to be doing double heads. We're going to be doing double inverted heads. So we have a very big congestion here. We're going to get another very big congestion here. We have double heads, evenly spaced out shoulders at that level, and shoulders must be supported on the neckline. So market after doing the head moves higher and begins to support above this neckline and shoulders. And I get these shoulders again. Back here. All right. So is this in line with the current fundamentals? We believe yes, it is, because the market is going to be recessed on weak economic performance until next year. That's by next year, the current decreases or the projected decreases in the short-term interest rates by the Federal Reserve as of coming September need to filter down into economic performance, give them 1 quarter. So we're looking at the end of the year. By the time that the current interest rate regime drops from 5.5 all the way down to maybe 4.75, that's when we begin to see economic recovery. That's when we're going to see better demand for oil. And you need about 1 quarter going into the first quarter of next year to consolidate levels, to test lower levels, do a consolidation between 65 and, of course, 65 and 75. All right, showing here 75, 70. And yes, a break above this here, buy stop must be at 78 as a matter of fact, but it's too high, so we'll attempt 75 as already explained earlier in case there are geopolitical breakouts. So this level here is very key for reversal. If you want to have a buy stop, $76. We always keep saying you want to take out level one, even if it is below the 200-point moving average. So if I rise to 76, take out that level in particular. On the 30 minutes, it shows at 75 and 75.50. Here it shows rounded up at 76. If I really expect to see reversal, I must take out this point, 76. So I can have a buy stop. Earliest is $75.